This is the Cowboy, and I'm going to be flying solo. Definitely today, it seems, and likely much of the week as the Gorilla's on vacation. So right now, what we're doing is we are broadcasting to YouTube and to our private group. This is the Beginner Live Lab. Okay, so this is Algo Factory's free material for the next 30 minutes or so. And then right about 9 o'clock EST, we flip over to just the private group where we talk some higher level things. But this is intended for beginners, people who want to consider trading and building algorithms. Just a couple of house cleaning items. First of all, we just have to remember that anything that we say on any of these broadcasts or website or anything else, that's all entertainment and education purposes only. And if you want to risk your capital in markets, please consult a licensed investment advisor and make sure you do your own research before taking any trades. And also, of course, we build algorithms on Algo Factory. It's in the name. So understand though is that it's not necessarily, people hear the word algorithm, they think, computers, they think guy with real thick glasses and, he's working on some supercomputer and he's doing some crazy. It's nothing like that. An algorithm actually doesn't even have to be automated. Most traders use a manual algorithm. Any successful trader, very high probability is using an algorithm, whether he knows it or not. An algorithm is simply where you have a number of conditions that line up and then you go ahead and take your trade, right? So that is, that's the kind of algorithm that we're talking about. And then, of course, once you have something like that that's in play, you can always hard code it. And, you can either code it yourself or pay a coder. We do have people we know who can code. And that way you can go ahead and have something trade, overnight when you're sleeping, things like that. Of course, my own experience with algorithms and hard-coded algorithms is that you have to actually pay as much attention to those as you do to a manual trade, because market conditions can change and therefore your algorithm can perform differently. So you really got to fine tune something like that. I still trade manually. I have helped to program using my data and expertise. I have helped to other people to program some hard-coded algorithms, the kind that we're sort of talking about right now that you're thinking of, where you just walk away and it does all your trading for you. And it's like I said, you still have to manage that. You have to know what you're doing. And that's what this whole process is. And most everybody that I've talked to has started with a manual algorithm first. It's just a way of trading using indicators and price action. And then once they've gotten to a certain level of success, they go ahead and program it. But there are those who start with the coding, and that is also possible. It can be done. The people build strategies and they just have the machine back test it. And yeah, that's all possible. So I know that we had some questions in our private group that, I might go over that are great for the beginners. So let me first go ahead and spread the link around so that a few people might have a chance to hop on this show. And then we'll talk about what we're going to talk about. So give me about 10 seconds here. 9, 8. Well, actually, we're like 6, 5, 4, 3, 2, 1. All right, maybe 15 seconds. Yeah. Okay. So that said, let me see here. There we go. The question that I was asked in our private group last night, in the middle of the night on a Sunday, because that shows you when I'm working. I pretty much work. I like the European markets, so you'll often find me awake and trading at 2 a.m. EST. And you don't have to do that. That's just the markets I prefer. Most people are actually going to start by swing trading. And so they don't have to sit and wait and do that. They're looking at trades that kind of coalesce over, say, a week or a few days, and then they go ahead and put in their orders. And then as they do that, those orders might hit in a few hours, and you can walk away from that. And that's most people have jobs. They don't have the ability to sit and day trade like I do and trade on low time frames, and just a trade coalesces over like a few hours, or you're in and out in an hour or two or less. So again, the swing traders are able to trade and still have a job, and have their life not change drastically in order to try to make a career trading. This is something where it does take time to build. We don't offer get rich quick. What we do, it doesn't require some genius, math level or anything like that, but it does require some discipline and some work. Just like anything worthwhile, there is no get rich quick scheme. And the question that we might be looking at, I can't remember if it was from Valley Girl or it was, let's see here. Trying to look for that question from last night. I know it was on the order book. Different kinds of orders was really the question. And it was from one of our beginners, which is perfect, right? So I'm just looking through last night to see who asked it. And if I can't figure it out, it's not the end of the world. We listen to this nice hip hop music here they have in the background. All right, well, I'm going to go ahead and just talk about the order book and the different kinds of orders that we deal with when we're trading, because there are you have stop orders, you've got limit orders, you have market orders, you have the ability to enter a trade, you can have trailing stops, and so all of these kind of terminologies do seem like they might be a little bit complex, if you will. Just, stop, market, what are you talking about? Like, it's just, people's heads start to spin. And even if you're a beginner, even in these beginner courses, it might be that your head kind of starts to spin talking about these things, right? So if that's the case, don't worry about it. People who trade, it's kind of it's a long learning process is what it is. There's a lot of material to pick up, and it takes most traders about 4 years to be profitable. Okay, so with some guidance, you might be able to shorten that up, and it also is going to depend on how much time you're spending, right? I mean, look, an hour a day, it might take you a little while, but you will eventually get proficient and profitable if you are able to, create the proper algorithm and just make sure you have some discipline. So that's how that works. Valentine is the one who asked that question. She must have direct messaged me. It's always best if we ask our questions where everybody else can see the questions, though. Let's do that from now on if we can. So orders. All right. Let me see if I can get out the paper trading on TradingView. I'm going to connect to paper trading. Okay, so paper trading is basically, it's simulated trading. So you have like a fake account, gave you a balance of $100,000. It's right here on TradingView. You have your chart, you hit this up arrow in the bottom right, you click on paper trading like you saw me do, right? And so now I can actually take orders, right? So first we'll talk a little bit about the kind of orders there are, and we will we'll discuss the order book and what that looks like. Okay, so when you're trading, it's an auction. In fact, you might hear when you look at the news, they talk about, oh, the auction was this, the auction was that, especially when they're talking about bond auction. But whenever you're trading, it's an auction. That's why, if you've ever watched on television or even been to an auction, you got the guy up front, blah, 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 and then people are like raising their hand. Well, that's on the buy side, and they're bidding, right? So when you're trading in markets, you have that scenario as well. And what that looks like is you have the bids, just like in an auction, right? And your bids are gonna be like, let's just say 450. Let's see if I can make this look good. 450, 440, and 438. And we'll do like, that's good enough for our purposes. Okay. And then we're going to have our asks. Now, asks are a little bit different. Let's just say, what was our top of our bids? 450. So we'll say 460. Then we'll do 465. And we'll do 468. Okay. Okay, so bids and asks are actually kind of like a store in a sense, where ask is like, it's like a swap meet. So somebody is selling their product at this price, right? So let's do it this way. We'll mark this out. Let me make these all a little bit bigger. Easier to see on the screen. Okay. Bids and asks. There you go. A little easier to see. Now, the way this works is that, bust out a call out here. So bids are an auction. What does that? Okay. So, at this point you're bidding this amount. So if you're trying to buy something in an auction, you're saying that you'll buy it for 450. This person's saying that they'll buy it for 440, right? And this is a passive way to do orders, okay? So if you're actually the person who's trying to buy, so you're buying with what's called a limit order. Okay? And that's just the terminology for, okay, you're going to limit your order to this price. Like, you're willing to buy at 438. Now, somebody else could say, I want to buy at 440, and you got to wait for them to get bought out before the price might come down to you, right? But if other people keep putting bids that are higher and higher and higher, then you might never get your price. If you're bidding in a reasonable way, you will tend to get your order, and it will save you money in the long run, because 9 out of 10 times you will actually get your order hit, as opposed to doing what's called a market order, and we'll get into that in a minute. But with a limit order, you're limiting your price, right? You call the price out, right? So you're willing to buy at 440, and the market has to come to you, okay? And then we'll talk about the asks, right? I'm going to prep a screen here. Give me a second. We'll actually look at a real order book here after not too long, but I just got to do something here. All right, so now the asks are like a store. We'll call it. We'll put product on shelf. So you're selling with a limit order, right? Selling with limit order. Okay, so what that means is that it's like a swap meet in a way. That's probably a better way to say than product on shelf. We'll say swap meet. So you're a vendor at a swap meet, and you have your items on a table at a price, and you set that price at which you're willing to sell. So it's like, okay, I'll sell mine at 468. Now other people might go under you and say, I'll sell mine at 460, and you get out bargained. But again, if you're asking a reasonable price, then chances are your order is going to get hit eventually. It might take a few hours, and if you're on a higher time frame, it might take a few days. But in the end, you'll save money because you will probably save money, most definitely over a market order. Because, like I say, 9 out of 10 times, if you have a reasonable price, your order will eventually get hit. So these are limit orders. Limit orders are passive. You go ahead, you set the price, you wait for the market to come to you, right? So that's a limit order. Okay, let me put that over here so that we have it clear. You set the price, market comes to you. Now, there's a second kind of order that we will talk about right now, and that's called a market order. And you now are no longer the bidder. You're the person who is going to meet the bid, right? So let's just say you want to sell. Then the bids are the numbers you're looking at. You're no longer setting a price at which you want to buy it. You're going to people who are saying that that they will buy at a certain price, and you're going to sell to them at that price. Okay, so there's a market order. It's an instant fill, and you are subject, let's just say fill price, subject to order book. So what does that mean? What does it mean that the fill price is sort of subject to the order book? Okay. Let's go ahead and put up with the limit order. It is it's not an instant fill, it's a passive order, not instant. It's because the market comes to you. Now, in this case, you are the market, and you are going, when it comes to market orders, you are the market, and you are going to the order book, right? So now, if you want to buy something, you're going to have to talk to the people who are selling, which is the swap meet, right? So if you're a market order, then if you want to buy something, you have to go to the swap meet and you have to find the best. You just have to buy whatever the best price is, right? So that's buying orders. Say buy. Okay. Now, if you want to sell something, then you are the auctioneer, right? And so whoever's going to have the highest bid is who you're selling to. And when you're selling at the highest bid, that is not going to be ideal for you. You want to sell. I mean, how do I did not say that properly. If you want to sell into the market, you are going to end up not doing as well, because the bids can actually go down as you're selling. So you can eat into the order book. When you set your ask way up here at say 460, then price has to come to you. The market has to come to you at 460. But in this case, the highest bidder is going to be below the lowest price of sellers, right? So you're going to end up selling at the highest bidder, but it's never going to be as good as being patient and putting in an order in the asks. Okay. Now the highest bidder is better than lower bidders. That's for sure. But you're never going to get as good of a deal as if you set your price and you wait. I mean, not never, but in most cases, when you're doing things properly, you're going to get a better price if you set and wait. It's just hard for a lot of people to do, especially if you are moving quickly. And also some people's algorithms actually can work better if they enter at market, especially certain price action algorithms. And entering at market has its place, right? So that's how this works. All right. So if you're at the market, the best price you're ever going to get is the top of the bids if you're trying to sell. But if you do a limit order, you set the price and you wait for the market to come to you. Now, if you're buying, in that case, with a market order, you're going to buy the lowest price that's available at the swap meet. But the difference is that if you just set your order down here that's lower than those prices, and you wait for the market to come to you, then that's obviously going to be lower than this, right? However, there are circumstances when a market order is better, and you're going to kind of learn that as you start to trade. It's going to become evident to you. But the vast majority of trading methods I've seen, having market orders ready and being patient, that tends to work out better in the end. If you have a super explosive, like breakout type algorithm where you're going to enter as soon as price breaks a certain area, then that might be a place where market orders make a difference. On a low time frame, there could be a lot of slippage. So like slippage is going to happen when the difference between the bid and the ask is really big. So let's just say this is like 560 and that's like 350. That's a very low liquid market. And on low time frames, tends to be a bigger spread. And, so in that case, if you're trading like day trading and things like that, it often can work out far better to have a limit entry because the slippage becomes a lot more. And we can explain slippage when we look at the next screen that I'm going to bring up. So let me go ahead and prep that screen. Okay, so it should work. Yeah. So what we're looking at next, as I bring this up, this is KuCoin. This is just a generic screen. There's no account here on the screen. And what we're looking at actually is, this is the order book right here. You see it says order book right there. Let me go ahead and I'm not seeing this on the screen share. Give me a second. There we go. Reshare the screen, and it looks like I do need to actually blow this up a little bit bigger to make it easier to see. Okay, so this is your order book. Okay. And let's see here. Yeah, Annie is asking, I'm looking at some questions. Is that like buy now on eBay? Yeah, kind of. So a buy now on eBay is where the customer, you're in an auction and you're doing your bids, but then eBay does have a price that they're willing, like the seller has a price they're willing to accept. So, they are like, hey, you know what? If you buy at this price, we'll take it. So yeah, that's on the sell side. So eBay would be like the at that point, like this, in a sense, like a swap meet, because they're actually setting a price as opposed to letting the auction play out. So, that's that. If they don't have a buy now option, I don't know if that's possible. But if there was no buy now option, then the auction just plays out, right? So the bids just do the job. So what we're looking at right now is an order book. Okay, so this is on KuCoin, which is a crypto exchange. You don't get to see the order book usually on Forex. I think people with like super high level data can see the order book, but but not on KuCoin. I mean, but you can see it on a like KuCoin. You can see it on the stock market. You'll see some order book data. There's such things as level 2 quotes, which you get to see the data like you're seeing on the screen. You get to see the depth of the orders. For example, okay, so in the prior screen, let me pop that prior screen back up. Where is it? Here. So in this area, in between the bids and the asks, this is the actual market price, right? So in here is where the market price is. It's what the last purchase was. And in between the bids and the asks is what's called the spread. Okay. And anybody who's heard me tell my story knows that I made a spread arbitrage algorithm. And so I was able to, basically I would buy at 450 and sell at 460, right? I just buy at 450 and sell at 460, and I just did it all day long. I did it in. I actually did it with a lot of money, and even though I would make a percent, on a trade, or if I was lucky, maybe more than that. I did it a few times a day, and while that exploit existed just for a few months, I was able to actually put together a decent amount of money. It moved, it was a very specific situation. It wasn't like a whole ton of liquidity, so I couldn't become a millionaire, because if you can get if you can get a few percent several times a day, and you do that for a few months, you could easily become a millionaire. So that opportunity was not there. But I was able to turn a small amount into a much larger amount. That became kind of my crypto nest egg, if you will. So that's the spread, what's between the asks and the bids. And the market price in the middle is the last price that was actually purchased, right? So how does that look on an order book? Well, this is Bitcoin, right? This 26681 that you see right here on the left, that's the market price. And there's not much of a spread in this case. You got this 26682 that I just highlighted. Remember, we're looking at the far left. There's only so much I can do to kind of change this screen. So it's that, you're not going to, I can't necessarily put this center screen or whatever. But on the far left, this 26682, those are the asks. And there are 22 Bitcoin worth of orders at that price. So right now there's 20 Bitcoin worth at this price that you can buy, and somebody just has that sitting ready for you to buy it. Now on the bottom at 26681, now it's moving, because it's always moving. At 26684, to whatever this bottom number is right here, those are the people who are saying they're willing to buy at that price. And then people go in and they sell to them at that price. But here, these are the people who are willing to sell at that price. So you go and you buy at that price. Okay. So this is pretty much a demonstration of the order book. Now, and then of course of limit and market orders. Okay. So how is that going to look on a paper trade? Okay. So the way that looks on a paper trade is, let's just say I want to buy something. Okay. So I'm going to go to a limit order. I'm going to set my stop loss. Let's just say that I want to take a trade that looks like this. I did start a couple of minutes late today, so I'm going to go a couple minutes over. Well, let's say I want to enter right here, right? And then, or maybe I think price is going to go down to here, right? And I'm going to be patient. I'm going to let price come to me, and then I'm going to go long. And the trade's going to look like, say, this. That's a pretty reasonable trade. I'm not saying, I wouldn't do this unless my algorithm told me that I could. But let's say I'm planning on the price making its way down to this area and then going up eventually. And then that's my plan, right? And let's just say all my algorithm says I could do that, and so on. And then that way, at the bottom of this box, if price goes down, then I'm out of the trade, right? I cut my losses. That's the end of it. So that's my stop loss, right? And that's a kind of order right here. Let's use a different format for this. Let's go to a call out. So this right here is a stop loss. Okay. And this is a take profit. And these are both orders. These are actually limit orders. Okay, but you're not in a trade yet. So those limit orders, they don't exist yet, necessarily. But if I was going to go ahead and take this trade, well, I'm entering right at where this meets right here, right? So where this arrow is, where the green meets the blue, that's where I'm going to enter. And that price is over here in gray at 1.06449. So if I want to do a limit order and wait for price to come to me, I'm going to type limit. I'm going to do a stop loss. Stop loss is the blue number, 1.05871. My take profit is the green number to the right, 1.07693. Okay. And let's say I'm going to risk $1,000. So I'm going to put, and this is the nice thing about Oanda, is this is Oanda paper trade. So, I'm not, this is, this paper trade account assumes that you have $100,000. Now, when you trade forex, there's pips, and a lot of times if you like trading on MetaTrader, then you have to understand how to convert pips, and we can even do a whole class on that. But I'm using Oanda, which you just put in the dollars. You don't have to think about pips, right? So we'll just say it that way. I can also type the risk in here as well. So it's going to account for the spread. That's why that number is going to be a little different. So anyhow, I have my stop loss, I've got my take profit, and now I need to set the price at which that order is going to be hit. And we said before, it's where the green meets the blue, right? It's where the arrow is going to head down to enter. It's where I want to enter, which is at 106.449, this gray number on the right-hand side. And the reason that number is there is because I use this long box. And if you've been through our basic courses, that long box is on the left right here in TradingView, right? So, 1, 2, 3, 4, 5, 6 down. Those are the forecasting and measurement tools. And I just go long position. And that's how I have that tool right there. Okay, so we set our price at 1.06449, the gray number on the right. 1.06449, okay? And then how long is this going to be in force? How long do I want this order to stay there? Because if the market takes a very different turn, if this trade is no longer a valid entry, then you don't want it sitting there. Because, right now, as we're pretending that my algorithm is telling me that price is going to come down to this area and bounce. But what if that doesn't, what if the market does something completely different, and then a month from now it comes back down here and it wants to continue down, and my algorithm says it wants to continue down, and I would never ever take this trade. So you don't want this trade just sitting there. Like you want to limit this for in a week. You could do a day, a month, or you could do good till date. And GTD means like you choose the day and time that this order disappears off of your book, right? So we'll just keep it a week, and I'm gonna hit buy. So now it seems as if I mistyped my stop loss. So I can simply move it up like this. I didn't type that in properly. And there you go. There's the trade, so that's how that works. That's what a limit order looks like. Now, if I wanted to buy market, okay, that means I'm going to buy it right here. Now you can see, if you look really carefully, how these two lines right here, there's a red and a blue. It might be kind of hard to see on your screen. So let's go to a lower time frame, and we'll do that, because you'll be able to see what happens when you take a limit order and it's not a lot of volume. Okay, not a lot of liquidity. So you should be able to see now a separation here. You got a red line on top and a blue line on the bottom. And if I go down to the 1 minute, it should be rather pronounced. Okay, so this is a 1 minute chart. This is where the crackheads trade. I'll use a 1 minute metrics to enter a trade, but the lowest I'll trade is on the 5 minute chart, and that's even kind of psycho. But let's say like a limit order, right? I might think that price is going to head back down to these lows right here. So I set a limit order right here, and I have a stop loss down below that. And that's the plan, is that price is going to make its way down to here and then head up, right? Now we just did a limit order, so I don't necessarily need to do one right now, but that's how that would normally work. But let's pretend for a moment that my algo says here's a good place to enter, right where price is right now. We'll just say that that's what's going on. If I set a limit order at 1.06792, where this blue meets that green, right where I'm going to put this line right here, if I set a limit order there, then what'll happen is the book's going to have to come to me. And the difference between these reds and these blues is the bid and the ask. Okay? On the top here, you see this red and blue on the top left. You see how the numbers are different, and there's 1.5 pips in between them. Okay, so you can go to babypips.com if you want to learn about pips. I'll talk about it in another class, but the point here is that there's a spread, and that spread is 1.5 pips. So if I were to limit buy or market buy, I'd have to buy the top of that spread, which is way up here. If I did a limit order, then the price, this red line would have to come all the way down to my price. So it's you're losing money in a way, right? So like if I did a limit order, right? Wow, price is moving. Let me see. It's I don't know why it's moving. Well, we're on the 1 minute chart, so price could just move. It's probably not. It's not really moving that much. It just looks like it. So if I just do a market order now, I go to buy, I go to market, I choose stop loss at 1.06735, and then I do a take profit at, we'll just say 1.069 just for the hell of it, just to have something on there. And then I buy it. You're gonna see how right now I want my trade to look like this, but that red line is above that. So if I enter, then the real entry is going to be higher. Watch. Okay, see how that blue line right here? That's my real entry. So my real entry is higher than what I originally wanted to enter. And so now my trade's at a loss. Instantly a loss. And until this this bottom blue line reaches where the entry line is, the trade entry line, which is this line right here, then I'm going to be at a loss. And I actually have to move this up here. So I'm having more loss area because I entered at market. I entered the top of the spread. I bought what people were offering. I did not wait for price to come to me. Now, had I waited, we're almost there. We're almost where it should have been, right? Where this red line has to come down to my order. So that's the difference. If you just are patient and you let the price come to you, you set the price right at where the green meets the blue, if you will. You set the price, okay, as soon as the market comes to me, that's where I enter. But if you enter at market instead of going limit, you're going to buy at the top of the spread. You're going to buy what people are offering. And what people are offering is generally never going to be as good as when you set the price. Okay, so we went quite over on the beginner class. I'm hoping that this explained everything to, the people who actually asked that question. I'm going to hop off of YouTube, but let me go ahead and type in the website. Just 1 second. It's algofactory.tech. Okay, so algofactory.tech is the website, and here's what it looks like right here. So it's, this is where you go to start your path. Even if you just want to become a trader and not worry about, say, automating your trades, this is a great way to build a manual algorithm. Okay, but I did just put the website in the what do you call it? I put the URL in the comment section on YouTube, so it's right there. I also have it right up on the screen. So come check us out. We are $49.99 a month, and the closest service to us that I can think of charges 6 times that. And we are keeping a low price because we want to bring people in who trust us early on with their time and money and reward them with such a low price. The price will go up. Now, as the price goes up, those who got in at this tier of service will be able to keep that price indefinitely as long as they don't let their membership lapse. So if you're interested, please come check us out, www.algofactory.tech. Thank you all for joining us on YouTube, and we will see you tomorrow. And again, the gorilla is on vacation this week. He may or may not join us. Obviously, he did not today.